Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're thrilled to be joined by Laszlo Szabo and Diana Biggs. Laszlo is the CEO and co-founder of Kiln, a staking infrastructure provider backed by 1KX, Crypto.com, Wintermute, Kraken Ventures, Consensys, GSR, and others. We're also joined by Diana Biggs. Diana is a partner at 1KX, a crypto VC that has led rounds in companies including Arweave, Pudgy Penguins, Rarible, Wallet Connect, and many more. In this conversation, Laszlo, Diana, and I break down the staking opportunity and Kiln's view of the space. We also use it as a jumping off point to explore 1KX's investment strategy. Specifically, we discuss staking as a crypto primitive, its potential to supercharge consumer and institutional crypto use cases, the investment thesis behind staking infrastructure, technical considerations, and more. Thank you very much for joining us today. Please welcome Laszlo Szabo and Diana Biggs. Laszlo Szabo and Diana Biggs, welcome to Rebank.
Thanks for having us.
Great to be here.
It's great to connect with both of you. Diana, you and I have known each other for a long time now, ever since both working on basically digital banking in London, maybe as far back as 6, 7, 8 years ago. So it's cool to reconnect now and talk crypto finance subject matter. And Laszlo, I think we'll get into your background, I'm sure, in many ways as we work our way through the conversation. So maybe to dive right into the heart of it, Laszlo, what is staking and what's the business opportunity related to it?
So staking in a proof of stake blockchain, it's the concept of locking your native tokens to earn rewards in exchange to secure the network. So you lock your tokens in proportion. You can validate the transaction of a network, and in exchange you earn rewards from the inflation and the network fees. So it's the mining 2.0, as you would call it. Mining was the way of securing and validating transaction on Bitcoin. And it was not really scalable, very capital and energy intensive. So we came out with this beautiful concept of staking.
Got it. So for the non-blockchain natives out there, it's basically a core part of the architectural design of certain types of blockchain networks that is related to the ability to deliver this consensus decision-making in a trustless way. Very fundamental to the actual architecture of the blockchain.
That's right. And that's how you would secure and validate and earn rewards on Ethereum or Solana or Cardano, these blockchains. So it's usually now in the crypto market, everything that is not Bitcoin.
Perfect. And what's the business opportunity that you see related to it? You've been working on Kiln now for some period of time. Give us the opportunity that you see in front of you with respect to staking.
Yeah, I can start maybe with a bit of my background and come back to the opportunities. I discovered Bitcoin in 2014 while in Tokyo. I was founder of BRD Wallet, which was the second largest Bitcoin wallet at the time. And it was like
Bread Wallet.
Bread Wallet, that's right. Remember Bread?
Yeah. Rolled into Coinbase, right? Coinbase acquired them?
That's right. And which started Coinbase Wallet, by the way. The Trailman brothers, Adam retired, is investing now, and Brent, who is still at Anchorage. So I met Adam and I bought my first Bitcoin when I came back to Europe. And it was really when I discovered Ethereum. I had a friend that would work at Consensys back in 2016 that I understood how you could create decentralized application. And the whole computer vision of Ethereum was different from being the digital gold of Bitcoin. And staking was already in the Ethereum white paper in 2015, but it took them a couple of years to support it, actually 6 years, because it was complex, was not ready. So Ethereum started as a mining network and then transitioned to staking. And the reason it's important, the reason it's interesting for customers is it's the primary reward you can get on a blockchain. It's predictable. You have 3 to 4% on your Ethereum at the end of the year by just securing the network, helping the network be more efficient. It's quite low risk if you think about it, having your 4% and on a low risk basis.
And is it fair to say that the opportunity, and potentially this translates into the business opportunity that you guys are pursuing at Kiln. If you can generate via effectively passive investment 3 to 4% returns, there's effectively lubrication of the entire financial ecosystem built on these chains. Is that how you think about the opportunity in the broadest sense?
Yes. And the source of the reward is, as the network matures, the inflation will go down, as the inflation of a fiat currency should not be as high as the economies mature. But the fees of the network will increase because more and more users, more and more people around the world are using Ethereum to do transaction, mint NFTs, do decentralized finance, transact in stablecoins, and so forth. So in that case, it's very sane that the more volume there's on the network, it goes back to everyone, our customers, our users that helped secure the network through staking in the first place.
Diana, how do you think about the staking opportunity at 1KX in the context of your broader investment thesis?
At 1KX, just about us. Firstly, we are a crypto native venture firm. We invest across the ecosystem from infrastructure, middleware, consumer. The firm was established back in 2018, and we've stayed pretty true to our original investment thesis. And this thesis is called the cost of trust. And so really at the heart of this is that we see all economic activity today is based on a layer of trust. And that trust is very expensive. In the US alone, market for trust, you could estimate around $28 trillion. And you'll be aware as well from working in a large financial institution, there are so many intermediaries and you pay a lot for the need for those. Our founders knew it very well from building their own businesses in Germany. And today there's increasingly a loss of trust in our institutions, our organizations, our media, our governments. And so really at the core of blockchain technology, what we see it as is a machine for trust. And we are replacing the trusted intermediaries with math and code. And ultimately, we see that there is a massive opportunity for trust-enabling networks that will be larger than that of today's organizations. And these networks, we see that as the future of coordination and organization. So we are investing in these decentralized networks. And this is a thesis that we've been doubling down on since 2018. And a critical aspect of these decentralized networks, because you no longer have a central party that's running an organization, is the need for the participants to take an active role in verifying the network and in providing the network security. That participation is then rewarded. And this is one of the most integral and exciting aspects of Web3. We saw this first with Ethereum's move to proof of stake. And then as we believe and as we're seeing play out, more individuals, more institutions, everyone will want to hold these digital assets and be part of these networks, which we see as the coordinating mechanisms of the future. And therefore, staking will be an integral part of that and of their operations. We think we're really at the tip of the iceberg of what's possible and that this space will continue to grow.
So in my mind, staking is basically a core part of the, I guess, incentivization mechanism of, maybe we focus on Ethereum specifically, but basically any proof of stake chain that incentivizes network participation, which ultimately leads to things like alignment, the ability to validate transactions, as we've said, in a trustless way. And also, because you're maximizing or at least incentivizing network participation, you end up with more participants and therefore lower risk of centralization or takeover by a single counterparty, which is the biggest risk of many blockchain networks. The ability for one party to kind of amass so much decision making that they can dictate untrue states of the chain. Now, I think of staking, at least as it started, as a sort of pure crypto native opportunity to basically, if I hold Ethereum, now I can stake it. And there are a number of very technical projects that build ways in which I can, as an investor, as a retail user, easily do that. But it seems to me like the bigger opportunity that staking brings, which I think, Laszlo, you at Kiln are focused on, is basically leveraging that additional, I think you use the word rewards, but that additional return that can be generated on otherwise dormant assets into different types of use cases or customer experiences that wouldn't otherwise be available. To use a very simple FinTech 1.0 analogy, in neobanking, you have a debit card and maybe you offer checking and savings accounts in partnership with a regulated bank. And that regulated bank basically pays you, the neobank, a portion of the interest that's earned on the deposits that you hold with them. And they pay you a portion of the interchange that's earned on the debit card. So now you, as the neobank, basically have a revenue stream which can fuel not only the growth of your business, but also other types of experiences, new financial products, potentially cash back, other types of user engagement mechanisms, value adds that wouldn't otherwise be available. And it's specifically because of this almost hidden 3 to 4% cash flow kickback, if you will, or rewards in the case of staking. I wonder if you see a similar analogy, Laszlo, and if what I just said at all resonates with how you think about the opportunity you're pursuing.
It does resonate. As you mentioned earlier, staking being the primary rewards on these blockchain by participating to the security and validation of the network. Here you have a reward that is decentralized with different participants around the world, but it enable decentralized finance, tokenized deposits, money market fund tokenized, and all of the financial system that will move into these on-chain world. And staking will play a big part of it, because if a majority of the financial system is now on-chain, staking is about governance. It's definitely about getting the rewards of 3 to 4%, but it's also about being part of this global ecosystem and having a word. And then you will have this 3 to 4% staking that is locked and not liquid, but then you can tokenize it, call it liquid staking, have a receipt, and then mixed product with more on-chain TradFi products, such as, again, money market fund, tokenized deposits, lending and borrowing on-chain. So we see this world being very much interconnected. And that's why, as a company, we started by providing staking to a platform that offers these rewards to their customers, retail or institutions. But in the future, we will also offer any kind of rewards that will flow on-chain. And these opportunities will be combined and live together on the chain.
Can you talk about some of the use cases that are getting most traction today?
Yes. So in the staking world, definitely Ethereum is 40% of the ecosystem. Then Solana might play 20, 25% of the markets. There are very interesting use cases because by far the largest crypto assets in terms of valuation and reputation is Bitcoin. You might say, oh, but Bitcoin is mining. It's not staking. Bitcoin was primarily a mining chain a couple of months ago, but now you have all an ecosystem of L2s, so chains that will transact and then anchor on Bitcoin, reusing the security of the Bitcoin blockchain. And in that case, these blockchains on top of Bitcoin uses staking. So we call it Bitcoin staking. And what it is, it's essentially a decentralized way to get rewards on Bitcoin, which, if you think about it, since FTX, it's very hard to get proper rewards on Bitcoin, right? The centralized lending and borrowing has been untrusted since the fall of FTX and Genesis. And now you start to have a decentralized way to earn rewards on Bitcoin again. So that's a very exciting topic. Then have you heard about restaking? That's the new narrative going around. So as I mentioned, staking is a locked asset. Depending on the blockchain, you locked several days, could be several months. On Ethereum used to be the case. When you tokenized your staking position, which we call liquid staking, you can reuse it on decentralized finance. So let's say you use staking plus lending. So you have the staking rewards plus lending rewards. It's a good opportunity for users. restaking is this concept of reusing the security of Ethereum and now other blockchains, but it started through Ethereum, and securing other networks, other L2s, for example, other chains that help to scale Ethereum, or other oracles, other chains that help to get data into Ethereum. And on the same staking collateral, on the same tokens locked, you will secure Ethereum plus other chains. So you will get rewards from Ethereum and all these other chains. So it's a great additional rewards opportunity. And it's also a way to bootstrap network more easily. That's a very exciting narrative.
How does that work, the restaking?
Yes. So you lock, let's say, 32 ETH. 32 ETH is a validator on Ethereum. You lock it on a smart contract, and the smart contract then points to the staking contract of Ethereum. And you reuse this staking position on the smart contract and say, hey, actually, I'm going to link it to another network. And if this network acts badly, both could be slashed. If Ethereum acts badly, it can burn the 32 ETH. If this network 2 or 3 acts badly, it can burn the same collateral. So in that sense, you reuse the same security to secure 3 different networks or 2 different networks, and you get 2 or 3 different rewards opportunities.
So the other networks are specifically designed to be able to be managed by Ethereum nodes, or there's an intermediary that's linking the two?
Yeah, that's a good question. And at first, yes. The answer is yes. You have to design at least your network node in a way that it could be plugged in or opt in, as they say, in the eigenlayer marketplace or other restaking protocols such as Symbiotic or Eigenlayer started the movement, and now it's a very flourishing narrative.
Got it. Everything you said makes sense. Quite technical, and a huge primer was probably necessary for listeners prior to this necessarily resonating as intuitive. But for those that are tracking, does any of this feel to you temporary? Is there some sort of like moment in time arbitrage opportunity, or is there some sort of natural scale where, yes, we need staking up to a certain point? Or is this a sort of layer of the stack or part of the ecosystem that can scale and get as big as ultimately blockchain infrastructure does across crypto native use cases, TradFi use cases, gaming use cases? How do you think about that?
I see it as different cakes. As traditional finance and many other transactional use cases moves to blockchain, we think that the primary consensus mechanism is going to be staking because of scalability, efficiency, and also it aligns token holders' interest better with the network and the network roadmap. So in that case, we think staking will win, and most of these transactions will be validated at some point through a staking mechanism. And it will scale through different ways, different narratives. Ethereum is one, Solana might be another, Bitcoin could be another in the future, or L2s, right? These chains that help scale a L1. And in this future, staking will be the primary mechanism and engine to validate transaction in this world. And we think that it will scale financially, but it will also scale politically, right? Today, you mostly stake because you want to earn your rewards. Tomorrow, as a state, as a company, being part of this decentralized network, you might want to stake because you want to be part of the governance of the network. You want to have a say on where the network will go, the roadmap of a specific network, and staking your asset will help do that.
I think that's a really interesting point when we think about the majority of technology in Web3 being completely open source. Companies are not really competing on technology, but rather it's around the network and what those networks can offer and the surrounding ecosystems. This is essentially the new paradigm that we're building towards. So being a participant in those networks and an active participant is a really important part of the proposition and something that you'll want to be in order to be integrated into these future ecosystems.
Laszlo, can you talk about the current state of your product, who your main customers are, and what the economic model looks like for Kiln?
So our main customers are crypto platforms today, custodians that helps you secure your digital assets if you're an institution, exchanges such as crypto.com or Bitpanda and other exchanges around the world, and wallets such as MetaMask or Trust Wallet, Ledger. So when you are a retail user and you want to access crypto in a self-hosted manner. So these are our customers. In the future, or we already see it, fintechs, right, neobanks, are coming into staking or are coming into crypto rewards. And banks will do an announcement before the end of the year. But you see very traditional banks in Europe, but also in emerging countries, because they understand the concept of crypto sometimes even more, are being interested by digital assets and now wants to offer rewards. And what we are launching around DeFi, so basically your ability to get rewards on your stablecoin, USDC, USDT, PYUSD. We think the payment industry will move to stablecoin in the coming years. And in this world, our product, which is a decentralized way of getting stablecoin rewards, this will be accessed by millions of users around the world using these fintechs to transact easier. And when they don't transact, they earn rewards on their wallets. That's the vision we are aiming for.
So how will that work? You have a stablecoin balance in your wallet. How does that earn you rewards through staking?
If you have a stablecoin balance on whatever crypto wallets you have today, or even embedded wallets, so you're on your phone, it's passkey, so you can now access your wallet through facial recognition. If you have 100 USDC, then you will, by design, put this USDC in DeFi. So that's another type of staking, very different from the protocol staking. And when you want to transact, you want to send this 100 USDC to Diana. You're in LA, she's in Switzerland. You can send this in a fraction of a block, 12 seconds or even less, compared to regarding different blockchains. You are essentially uncollateralizing, unstaking these USDC from DeFi and then transacting it in a fraction of a second. So you're earning rewards. When you're not earning rewards, you transact. The person that receives it, if they click this button of, oh, I want to earn rewards by default, is also earning rewards on this wallet. And the moment they want to transact, it's being uncollateralized and sent to another user.
So in that case, I guess the rewards that the stablecoin's earning would be through contributing them to like a DeFi lending protocol or something, as opposed to actually staked in the form of, say, Ethereum securing the underlying blockchain.
That's right. So lending protocol in DeFi, and in the future, you could imagine it's even a different product with a different risk profile, such as the money market fund tokenized, right?
Mm-hmm.
Or tokenized deposit.
Yeah. Got it. And so basically, Kiln, what you're focused on is building connectivity across access to the underlying L1 staking, integrating some of these DeFi protocols, which can generate rewards, and being able to wrap that into an API suite that you can then pipe into custodians and in the future, potentially banks or neobanks, the types of counterparties that you mentioned?
That's right. On protocol staking, we run validators, we run reporting, we run APIs that connects to custodians, wallet exchanges, and we also run smart contracts on protocol staking to automatize the rewards mechanism. You want the rewards mechanism to be completely on-chain. And on DeFi, it's also a set of smart contracts and APIs and widgets, so that a platform can distribute it to the users while definitely earning revenue themselves in a simple manner.
I think similarly, how we looked at it, the offerings were across 3 user profiles. So you have the retail, the everyday users, and these are people that might be quite new to crypto. They're using centralized exchanges. They're using wallets like MetaMask. And what they're really looking for in this experience is a simple UX UI. They are looking to get educated and learn and maybe dipping their toes in the space, and they want easy access. So that's what they'll value in terms of the type of proposition that they're able to access. Then you have whales, some of the crypto funds like ourselves, like more sophisticated actors. They won't need the education. They won't care about UX, UI, or easy access necessarily because they know how to work these networks. They're going to value flexibility, customization, security, and self-custody, which is possible here and which is like an important aspect, and the composability. So with some of these new innovations as well, like liquid staking and restaking. And then there's the institutions. They're quite new to this, but they're moving in. We're seeing already with the asset managers in Europe and in Canada that have ETP and ETF offerings. We already have staking products in these markets, and we expect that is going to continue. And these institutions have a very different set of requirements. Obviously, the highest standard in terms of who their partners are, the certifications, slashing insurance, reporting and accounting integrations, legal and compliance. So you can tailor these offerings, and that's what a firm like Kiln are doing to these different groups, and also evolving new product opportunities across each of those sets.
That's super helpful and makes perfect sense. So basically, you think of three different customer segments in a sense. There's the, call it retail users, and the opportunity there is to provide probably API-based infrastructure to the parties that are serving these retail customers to make it super easy for retail investors to one-click stake, earn rewards. If you're one of these platforms, the Kiln customer, you could either pass all of the staking rewards through to your end customer. You could potentially split them with your end customer. You could potentially, to the extent that you maybe even custody crypto on behalf of your end customers, you could stake on behalf of your customers. You could earn revenue, and you could use that 3-4% additional income to provide marketing rewards or new experiences back to your customers. So that's one. Category two, basically sophisticated crypto players that are maybe in many ways looking at it more from a sort of financial investor use case and how can you optimize returns. And if you have access to an additional 3-4% yield, low risk on your balances, that can be useful. And then lastly, and maybe we can expand more on that, the ETF providers. Can you talk more about that opportunity? We had Ethereum ETF launches here in the US just a few weeks ago. I think in other jurisdictions, you mentioned Europe and Canada, there have been different exchange traded products which have been linked to Ethereum for longer. And the opportunity there is for fund managers, BlackRock, Van Eck, people that are managing Ethereum ETFs to basically stake the entire fund balance and earn additional yield, additional rewards on the fund AUM. Is that the concept?
Yeah, exactly. As this is a space that I worked in prior to 1KX. These crypto ETPs were originally launched in Europe and Sweden. The first one was all the way back in 2015, if you can believe it. But just since 2020, we've gone from 17 products. There's probably over 200 today. Earlier in the year, it was 180. So there's a lot of crypto ETPs, exchange traded products out there, whether they're exchange traded notes or some of them like the ones in North America, ETFs. So some of these providers have been able to stake the assets they're holding and then keep those rewards for themselves, and it's helped fund their business. It's particularly helpful as we've seen the fees dramatically decrease. I think typically in Europe before we were seeing even 2.5% for some of these products. The US Bitcoin spot ETFs helped speed up the fee wars there. And so this can help cover some of the costs related to all of the intermediaries that you have in these traditional types of products, the custody fees, etc. But we are already starting to see now, because customers do start to understand. And also it's a competitive differentiation where there's products that actually do offer the staking rewards to the end users. So I think there's about 14 of those today, probably more, but one ETF in Canada, I believe, that is a staking ETF, and then a number of the ETPs here in Europe. And actually, this, I think, is an area where staking providers can be able to help in terms of the liquidity needs for when you are staking, because obviously you can't stake 100% of the assets. You need the liquidity of the underlying. And I'll let Laszlo speak to one of their product innovations that's focused on this space.
That'd be great. One of the, I don't want to say criticisms, but one of the fears that some voice around staking, and especially very easy staking of the type that many players are building now, is it is the natural conclusion that basically all ETH gets staked. And then how do you drive network activity? Does that help the security of the chain? Does it hurt the security of the chain? Does it result in greater centralization if everyone's staking through the leading one or two service providers?
There are two topics there. One is centralization topic, and the other one is how much and what should be the percentage of staked ETH that should be on the network to keep a part of these ETH liquid so that you can transact, so that you can enable DeFi, so you can enable activity on chain. That is the application part of the Ethereum network. So on the second part, the Ethereum foundations now will come with a design that inflation will go close to zero as much as we get closer to 35% of all ETH staked, which means basically they are pushing through an incentive to, let's say, unstake or not stake your assets if there's more than 30 or 35% of the network stakes, so that the application layer is being pushed. And majority of the ETH, 65, 70%, is still being remaining liquid to transact in payment use cases, transact in gaming, transact in identity, or whatever use cases will happen on chain. So that's one. The second is the decentralization aspect of staking and Ethereum in general. That's a big topic because that's also the criticism from some of these regulators say, oh, but staking might be considered security because it's a centralized product. We think it's not. We think, for example, compared to Bitcoin, the Ethereum network is more decentralized. On Bitcoin, you have two mining pools. It's an association of different miners that regroup to mine the rewards on the Bitcoin network. They own more 60% of the network, which doesn't happen on Ethereum. You have Lido that is smaller than 30%, and then you have a lot of big operators and then a lot of smaller operators. There's a famous slide from Vitalik Buterin from a month and a half ago in Brussels that shows actually how the Ethereum network is more decentralized than the Bitcoin network. But then it's a continuous battle, right? You have to incentivize for what we call solo stakers. You have 32 ETH, and maybe tomorrow you will be able, in one click of a button, to run a validator on your phone and to secure the network yourself without passing through a company like us, which we think, again, is great because if you're an asset manager, if you are a crypto native fund, you will still need performance, reporting, insurance that you with your phone staking alone won't be able to provide, but at least you will be able to keep the network a little bit more decentralized.
Is that the product that Diana was referencing that you guys are working on?
The product that Diana was referencing, it's a product what we call tokenized validator. So if you're an ETF, you have T+1 or T+2 redemption requirements, depending on the jurisdiction. You need liquidity. You can stake 100% of your assets because if there's X amounts of ETH or ETF ETH being sold, you need to sell them. And if they are all staked, you could be locked more than a week or so. So what we did is on a 32 ETH validator, we tokenized the validator on a one-on-one basis. And instead of unstaking, have it to unstake and waiting for 1 or 2 or 3 weeks or months, it depends, it's very on Ethereum, you can sell the token, the receipt, which enables you to be liquid by the day or by 2 days. And in that sense, you can stake a part, so directly staked, locked part of your assets. And then you can have a part of the other assets that are tokens that you will trade between these different ETFs so that you can be liquid and stake more than 50 to 60 to even 100% in the future of your assets as an asset manager. So that's something we've been working for months, if not years. And we've launched recently on mainnets and has been seeing a lot of traction as we work now with half of the ETPs providers in the top 10 ETPs providers in Europe. And we'll do other announcement of design partners. But it will happen first in Europe and hopefully in the future in the US.
Excellent. We've talked about a few different kind of geographic regions at this point and activity in various spaces. So from a US perspective, as far as I can tell, staking is virtually off limits. I think Coinbase and Kraken ended up having to pay fines and ultimately remove staking products from the market, at least direct to retail staking products. Seems to be a different landscape in Europe and maybe other geographies. Can you talk at all about the jurisdictional differences and your future expectations for how the market might hopefully ultimately align globally?
First of all, Coinbase is still offering staking to their retail users in the US and their institutional users as well. There are other retail venues. Kraken stopped, but might come back to it. Or do you have Binance US, for example, there's a customer is also offering staking to US retail users and customers. In the US, as you probably know, I'm sure you're very aware, they've been getting this approach of regulation by enforcement, which we think is not perfect or the right approach. And when it comes to staking, as you mentioned, Coinbase and Kraken strongly contest that staking is a security to the SEC, saying that if you take it under the Arweave test, it's not being considered as an investment contract. Ethereum is a decentralized network. Staking is part of Ethereum. It's not something that you can decouple, right? Staking and Ethereum, that's how you secure and validate the transaction on the network. So in that case, yes, in Europe, they've been taking this approach of not regulating staking, saying DeFi and staking are decentralized reward mechanism. And it's not under MiCA, market in crypto asset regulation in Europe. It's not on the MiCA umbrella, and you definitely have custody, you definitely have stablecoin issuers, you definitely have centralized lending, but you don't have anything DeFi and staking on the MiCA, and you can pretty much operate with the regulators. There's no staking license per se. They could have a staking license, but I don't think it's going to be the case in the next several years in Europe. But again, at least there's a much open approach, more business-driven approach that we have in Europe compared to the US.
Laszlo, you mentioned parties like Lido and Eigenlayer before. EtherFi, I think, is another staking-focused Web3 project. Are those competitors of yours, partners? How do you think about how various component parts fit together?
As often in crypto, there's this cooperation competition. Like a lot of these large names, platform protocols are partners at first and sometimes competitors, but still partners over the long run. And we still pretty much collaborate. So on Lido, we are running nodes for Lido since 2021, so 3 years now. So it's a partner. It's also the case for Eigenlayer. Eigenlayer, we're using their protocol to run what we call AVSs, nodes of Ethereum that being plugged to nodes of other chains that I mentioned earlier. And sometimes in the case of Lido, we have competitive offering, but Lido is a very retail crypto native driven protocol. We are much more of a institutional type of player when we talk about liquidity of a staked assets. But again, we're very close to the Lido team still. Credits to what they've done. It's a $50 billion protocol, maybe less. I don't have the right numbers at the top of my head, but they've built an amazing business, an amazing company, an amazing protocol. Congrats to them to have democratized liquid staking that now we all use one way or another.
All right. So Laszlo, to wrap up, what are you most excited about in terms of your roadmap as you think over the next, say, 12 to 18 months?
In general, I'm very excited about a couple of innovation that happened the past year or 2 years that can put a wallet in the hand of my mother. So that's the big one. How do you get mass adoption in crypto? And I think what's happening around account abstraction, another, by the way, a portfolio company of 1KX, Safe, but other also companies innovating in the space, where you can have a wallet at tip of your finger, one click, Face ID, passkey, and you don't even know there's a wallet in the background. That's super powerful. And it enables use cases like remittances, having dozens of millions of customers using stablecoin and transacting from country to country at a fraction of cost, and now maybe earning rewards with us. It enables use cases such as identity. Wallcoin is a very good example where kind of your herb and you have your wallet using a kind of abstraction in the background as well. So we're going to be building ways for these hundreds of millions of users being onboarding into crypto, being onboarding into Web3 through account abstraction and a simple way to access a wallet with or without knowing it. We'll be pushing these users to access rewards. That's our mission, to democratize value creation in digital assets. And we'll definitely try to democratize these values and guess what crypto is about.
Excellent. Laszlo, congratulations on all the progress you guys have delivered to date. It sounds like you're really headed in a compelling direction and that there's a huge market opportunity in front of you.
Thank you so much, Will.
Laszlo Szabo and Diana Biggs, thank you very much for joining us today.
Thanks, Will.
Thank you, Will.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.